Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So, do you remember field trips when you were in school? You know, like most kids, I loved them. One of my favorites, and I remember it pretty vividly, was a trip to the fire station. It was first or second grade. And for me, the field trip, it wasn't just about getting out of class for a day, although no doubt that was part of the appeal. But I really enjoyed learning how the quote-unquote real world worked. It was fascinating to me to see all of the equipment on the fire truck and for them to explain how they used these various tools. And as I got older, we often went on a field trip to a working farm. Loved that too. You know, just seeing all the animals and learning about animal biology and farming and all of that stuff. Just fascinating. So last week, I got to go on a field trip for Money Metals. I got to go out to our main facility and our bullion depository out in Eagle, Idaho. And the purpose of the trip was to film videos for marketing and social media. We filmed like well over 100 videos while I was there. So it was definitely a work trip. However, it wasn't unlike those school field trips because I got to learn a little bit more about how the real world at Money Metals works. And there are several things that stood out to me on the visit that I'm going to share with you today. But before we do that, I definitely want to thank you for listening to the show. And I say it every week, but I really do appreciate the fact that you take a little bit of time out of your busy day to listen to me. And I know there's a lot of stuff out there for you to choose from, and I just really appreciate it. So I want to say thank you. And if you would do us a favor, you can help the show by going to wherever you listen to your podcasts and writing us a review. Give us those 5 stars or the thumbs up or whatever metric they use. Maybe even write us a little review if you have time. And another thing that you can do is share these episodes on your own social media channels. You know, if you find value in the show, other people might as well. So if you would do those things, I would appreciate it greatly, but mainly just want to thank you for listening to this show. So, like I said, there were a number of things that really stood out to me on my visit out to Idaho. And it was the second time visiting the office, but this time I actually had a little bit more time to interact with people on this trip. And the first thing that struck me is the quality of those people. I'm talking, you know, from the security team to the folks down in fulfillment to the precious metal specialists working the phone. Everybody is top-notch, professional, knowledgeable. And, you know, that says a lot about the values of the company. And I can tell you from having worked for Money Metals Exchange for over 2 years now, the management is absolutely solid. It's a great company to work for. And that is reflected in just how good the employees are. Now, if you listen to the show often, and if you get all the way to the end, I almost always talk about the precious metal specialist at Money Metals. I say, call 800-800-1865, talk to a precious metal specialist because these people are fantastic and they can answer your questions. Well, I spent some time interviewing some of the sales team for short videos. And I may have actually understated how good they really are. As I was doing these little interviews, I would ask them, you know, how they answered various questions. And they were all over it. And one thing that really struck me is they have this genuine desire to help. They really want to know what your needs are, and they want to help you achieve your goals. They want to help you preserve your wealth. They care about helping people, preserve their purchasing power with sound money. And it's really obvious that they love what they do. They not only know their products, but they understand the economics behind monetary policy. I'll be honest, much more deeply than I really expected. They can explain exactly why your dollar is devaluing every day. And they're engaged enough, again, to find out your goals. Now, keep in mind, these folks aren't working on commission. So, you don't have to worry about somebody trying to bait and switch you into some higher premium product. What they're going to do is they're going to ask you a bunch of questions. They're going to answer your questions, and they're going to try to help direct you to what's going to be best for you. Because no matter what you purchase, it's all the same to them. So, you'll get to see some of the videos that we made if you're following our social media channels. And I really want to encourage you to do that. We have a pretty strong social media presence. We're on all of the major platforms: X, Facebook, Instagram, TikTok. So if you follow those channels, you'll get to see some of the videos that we made. And you'll get to see a little bit behind the scenes and get to meet some of these fantastic precious metals specialists, not in person, but at least put some faces with the voices. So the other thing that is at our facility, we have all of our offices, but that's also where our bullion depository is. And it is the largest bullion depository west of New York. So it's one of the biggest in the world. It's bigger than Fort Knox. And again, I may be a little nerdy, but it's so freaking cool. And one of the things that I'm sure would blow your mind is the security. And I'm talking about the security tech and the security personnel. Now, not going to go into details because not going to give away our security secrets, but just suffice to say it is tight. And, the security team, bunch of great guys, former law enforcement, former military, and just they're really laid back, but I wouldn't mess with them. And, it's interesting because the employees themselves at our facility add really another layer of security. And the company actually offers firearms training to any employee who wants it. And once it's completed, they're encouraged to carry a firearm at work. There was actually a class while I was there, and there was a whole group of people that were taking the classroom portion of the firearms class, and then the next day they went out to the range to actually shoot. So how cool is that, right? It's a great perk for the employees, but also it is, again, another layer of security at the facility. And I'll tell you this, I can store my gold and silver in our depository with complete confidence. And it's not just the security, it's the procedures that are in place. If you have metal stored in our depository, it's segregated, it's stored in its own sealed box. Anytime it is open, that seal is recorded and replaced. Everything is carefully logged. You can actually get a photo of your metal in the vault on an annual basis just for your additional peace of mind. And, while I was there, they were actually prepping for an audit. The U.S. government should take note. As you probably know, thorough audits aren't a thing at Fort Knox, but they are in Eagle, Idaho. And not only do we undergo external third-party audits, there are also rigorous internal audits processes in place. So there's auditing going on all the time. And I can assure you, they know exactly what is in the depository and exactly where it is. Something that I guarantee you the folks at Fort Knox can't tell you with any absolute assurance, which is exactly why they need to audit that gold. I talked about that on the show a few weeks ago about the audit problem, and also the fact that a lot of the gold that's stored in Fort Knox is not pure gold. It's mixed with other elements, and a lot of it's not really appropriate for international trade. So if you haven't caught that show, you might want to check that out. It's pretty interesting. So, as you can probably tell, I'm pretty happy and proud to be associated with Money Metals, and nobody told me to say any of this. Nobody said, "Oh, Mike, you should do a show about what you saw." I just did this on my own. It wasn't even suggested. I share all of this because I was genuinely impressed. And I want you to know that if you're looking for a place to buy or sell gold, or you need a place to store your metal, you can do business with Money Metals Exchange with complete confidence. I put my own, my own word, my own face behind this company. And, think of it as a personal recommendation. So anyway, that was my little field trip out to Money Metals, our facility out in Idaho. So let's talk a little bit about what's going on out there in the precious metals markets. If you're watching the ticker today, gold is way, way up. Let me see what it is right now. We are up $126 so far today, and silver's up a little bit over $4. And this is all because there is some optimism about a peace deal with Iran, and that would be fantastic. I hope that it comes to pass, but I'm not going to bank on it at this point. It's just so crazy. You know, I've talked before about regime uncertainty, just not knowing what's going to happen next. That's why it's so difficult to do any kind of economic planning in this environment. But as of today, there's some optimism. So gold and silver are way up. But, you know, in general, we've seen this range-bound trading over the last couple of months with a lot of volatility, and I think this is going to continue until there is some solid resolution to this Iran business, and hopefully we're at the first step today. As I've mentioned before, wars don't tend to have a lot of impact on the gold or silver markets beyond an initial safe haven bump. And we've definitely seen that with gold and silver in this recent conflict. In fact, it sold off significantly after that safe haven bump due to worries about the Fed holding interest rates higher for longer. As the conflict continues, historically, other factors have tended to drive precious metal prices, particularly monetary policy. And that's the big one right now. It's the Fed, right? Nobody can really get a bead on what the central bank might do because everything is just kind of all gommed up right now. But we did have another Federal Reserve meeting last week, and they didn't do anything. No real action. As usual, the big news centered around what Powell and company said and didn't say. So for the third straight meeting, the FOMC held interest rates steady at between 3.5 and 3.75%. Comes as absolutely no surprise given the uncertainty facing the economy as the conflict in Iran drags on. In fact, you won't often hear these words out of my mouth, but I think the Fed basically is doing the right thing. Just kind of hold pat and wait and see how things play out. And so then they can plan whatever mistake they're going to make once the Iran conflict is over. Couple interesting things in the official FOMC statement. It noted that, quote, inflation elevated, in part reflecting the recent increase in global energy prices. So acknowledging that prices are rising as reflected by the CPI, absolutely true. But as we've talked about before, the CPI isn't really reflecting inflation. It's reflecting it's reflecting price inflation, but not inflation as we've historically defined it in economics. So rising prices is a symptom of monetary inflation. So they're just telling us that inflation is elevated. They mean prices are going up. True. Real inflation is elevated as well. You can see that in the increase in the money supply, and you can see it in the fact that the Fed's balance sheet is getting bigger. The Fed continues to run quantitative easing. Of course, you're never going to hear them say the words quantitative easing, but that's exactly what they're doing. They're buying bonds, they're creating money out of thin air, and they're injecting it into the economy. So while in one sense you could argue that, oh yeah, the Fed's really tight, they're holding those interest rates steady, they're not really because they're running QE. The FOMC statement also emphasized, quote, developments in the Middle East are contributing to a high level of uncertainty about the economic outlook. Again, nothing at all shocking about that, but it kind of gives you insight into what's kind of driving their decision making, and they don't know what to do. They don't know what to do because they don't know what's going to happen. I mean, nobody knows, right? It's this crazy kind of, I don't know. I can't think of the word for it. It's like a spider stuck in a web, right? So both of those statements check out, and that's why most observers think the central bankers are going to just hold rates steady in the near term, despite the market's desire for rate cuts. And even despite some people saying, oh, well, maybe they'll raise rates. Don't really think they're going to do that either. So Powell seemed to confirm this perception, but he also tried to minimize the expectations of a rate hike, signaling a patient stance for the time being. Powell said, "We're in a good place to move in either direction. Nobody's calling for a hike right now, so it really is going to depend on how things evolve." That's a really fancy way of saying we don't know what we're going to do next. Powell also interestingly claimed that the current interest rate level is effectively, quote, neutral. He said, quote, "I've always had it between 3 and 4%. We're a little north of 3.5%, so that's well within the range of what I consider reasonable." Okay, Powell, it might be reasonable, but it's not neutral. And your own Chicago Fed National Financial Conditions Index bears this out. If you look at the NFCI, you will find that it decreased to negative 0.52 in the week ending April 24th. A negative number indicates a historically loose monetary environment. And it's been like this, honestly, through the entirety of the tightening cycle. We never actually got to historically tight monetary policy. So while the Fed did hold rates steady as expected, the vote was far from unanimous. There were actually 4 FOMC members who voted against the move or language in the statement. And the last time we had 4 members dissent from an FOMC statement was in 1992. So usually these guys kind of walk in lockstep, but not so much right now, which I guess isn't surprising given the amount of volatility and uncertainty in the economy and in the financial markets. As he has in the last several meetings, Trump appointee Stephen Myron actually lobbied for a quarter-point rate cut. So he's having nothing of this rate hiking, and he thinks they should cut. And then we had Beth Hammack, Neil Kashkari, and Lori Logan. They dissented due to language in the FOMC statement. And the trio agreed with holding rates steady, but they said, quote, they did not support the inclusion of an easing bias in the statement at this time. So unlike Myron, these 3 are kind of leaning toward, we might have to raise rates down the road. So let's take language out of the statement that makes it seem like the next move will be a cut. And they're referring to the clause in the statement that says, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Since prior adjustments have all been downward, they thought including the word additional hints at another cut in the near future. As one analyst told CNBC, one gets the sense that there will be several meetings at least before we see any rate changes by the FOMC, agnostic to who the Fed chair is. So I think he's absolutely right. And, all of this feeds into the current perception that the central bank is going to keep rates higher for longer to battle potential price inflation due to the energy shock from the war in Iran. If you're following the markets at all, you know that gold and silver have struggled to gain a footing since the conflict began due to this perception. Because gold and silver are non-yielding assets, they always face headwinds when interest rates are higher or when they're expected to rise. However, the interest rate hawks seem to be, in my opinion, ignoring the proverbial elephant in the room, and that's the debt black hole, right? The Fed has addicted the economy to easy money. It's incentivized billions of dollars in debt. Government debt, we're all well aware of. Consumer debt, record levels. Corporate debt, record levels. So we're swimming in this big pool of debt. The Fed pumped nearly $9 trillion in new money, that's inflation, into the economy through quantitative easing alone from the onset of the Great Recession through the pandemic. And that was on top of the inflation it created with nearly a decade of 0% interest rates. So that monetary malfeasance has consequences, right? It created a massive debt bubble, along with all kinds of malinvestments in the economy. And the full impact of all of that still hasn't manifested. I think it was about to manifest back in 2018, 2019, before the pandemic. We were seeing the economy getting shaky. I think all of the Great Recession era quantitative easing and money printing was about to unwind, but the pandemic gave the central bank an excuse to basically double down on the monetary heroin and kind of kick the can down the road. But here we are. We still have to reckon with all of this, with the debt and the malinvestments. Debt-riddled economies do not run in a higher interest rate environment. And this is precisely why President Trump and many others have been pushing for rate cuts all of this time. They want the stimulus. They understand that the economy runs on this stimulus. They want to facilitate more debt to keep the bubbles inflated. In other words, they want the addict to get more of his drug. Now, that said, the notion that the Fed should hold interest rates higher is absolutely correct in my view, even without the price pressure from soaring energy prices. And strictly speaking, this is a price shock, not inflation as properly defined, as I've already alluded to, right? This is price inflation. Monetary inflation causes price inflation, but they're not the same thing. Regardless, price inflation remains well above the mythical 2% target. Meanwhile, the money supply is increasing rapidly, as I've already mentioned. And I could make an argument for rate hikes at this point, even without any price pressures from oil, because the central bank never did enough to kill the inflation dragon to begin with. Keep in mind, Fed Chair Paul Volcker back in 1980 had to jack up interest rates to 20% to slay the price inflation of the 1970s. We got nowhere near that, right? So you could definitely argue that it was kind of a half-hearted effort. The central bank tightened monetary policy just enough to subdue the inflation dragon and then hoped it wouldn't get up off the mat. And now the Fed has gone back to creating inflation. Right? Remember, monetary policy is still loose from a historical perspective, and the central bank is running quantitative easing operations. I know they won't call them that, but that's what they are right now. So they're creating inflation. By declaring victory over price inflation and easing monetary policy over the last couple of years, the Fed effectively committed itself to creating more inflation. So why don't they hike? Right? I just made the argument. It's easy to make, given the stubbornly high CPI and the looming trickle-down effects of $100 oil. It's hard to dispute that a rate hike might be the proper move. Why don't they do it? Why isn't anybody talking about it? You don't really hear anybody favoring rate hikes. You have some people worrying about it, but nobody's saying, yeah, they need to hike. Here's why. Because they know that rate hikes would run a dagger through the heart of this debt-riddled bubble economy. That's the reality. And everybody knows it. Nobody's going to say it out loud because nobody wants to let that cat out of the bag. They don't want you to think about that. But that's the reality. The economy is addicted to easy money. When you take a drug away from a drug addict, they go into withdrawals. It's as simple as that. It's interesting. The debt problem was actually in the spotlight for a moment. I'm talking about the national debt last week after the U.S. debt reached yet another ominous milestone. So you'll remember back in March, the national debt surged to over $39 trillion. That was a milestone. Now the federal debt to GDP ratio has crossed the 100% threshold. So in other words, the U.S. government owes the world more money than the economy's total annual output. And it's actually worse than that. There is additional federal debt that's not factored into the data that was reported last week to help produce this eye-bulging headline. So the last time the debt held by the public exceeded GDP, it was briefly, it was during the COVID era when governments effectively shut down the global economy. Before that, the debt to GDP ratio hadn't exceeded 100% since World War II. Now, you expect a lot of borrowing and debt during a world war, right? But our government managed to achieve this without a war. Well, I mean, I guess we have the Iran war, but this debt problem came far before the war, right? We're not in any kind of economic crisis. We're just running up debt. So to put this achievement into perspective, the average debt to GDP ratio has historically hovered around 50%. So we're double that. The news actually created a little bit of a stir over the weekend, as such news often does. I saw a few headlines, a little bit of talk about it. But as Newsweek noted, quote, Congress appears uninterested in countering the trajectory of this debt. Committee for Responsible Federal Budget President Maya McGinnis pointed out that despite the general apathy toward Washington, D.C.'s borrowing and spending problem, it really does have negative effects on the economy. And, she's kind of on to something here, because when I talk about the debt, a lot of time people, their eyes glaze over and they're like, I don't care. Because we've been talking about a debt problem for decades. I mean, all of my life, I've heard people worried about the national debt. And I mean, I guess at some point you can say, well, nothing's happened, so it's probably not a big deal. It is a big deal, right? As McGinnis said, the debt slows economic growth, it pushes up borrowing costs and prices, and leaves us vulnerable to a fiscal crisis in the future. All of that's absolutely true. She went on, she said, there are good milestones and bad ones, and this is the worst kind there is. Can't disagree. And, you know, I can back her up on her assertion that large amounts of government debt slows economic growth, right? You have a private economy and you have a government. And when the government gets bigger and bigger and bigger, it is always at the expense of that private economy, right? A well-known paper published back in 2010 by economists Carmen Reinhart and Kenneth Rogoff showed that when debt to GDP crosses the 90% threshold, it tends to retard median economic growth by 1%, and average growth falls considerably more than that, up to 30%. So in other words, this debt is bad for our economy. It is hurting us. We don't see it, right? It's one of those unseen effects, but it is. Our economy would be more vibrant. We would be doing better if the government wasn't spending and borrowing $500 billion every single month. Now, I'm going to concede that in reality, the debt to GDP ratio rising above 100% is basically just a symbolic event. As Newsweek noted, it doesn't create an immediate crisis. But look, anybody who doesn't recognize that this is a huge problem is out of their freaking mind. And unfortunately, it appears that most elected officials out there are out of their freaking minds, or they have their heads buried in the sand. And I'm talking about primarily people in Congress and in the administration. You know, they read these headlines and you might hear a few folks express concern. You've got your Thomas Masseys out there, but then Congress goes right back to spending money. So I don't know. I mean, at some point it's going to catch up, right? I wanted to touch on something else. When I saw this headline, I was a little bit confused because I follow the national debt clock. And if you go there, you'll notice that they have a debt to GDP ratio showing, and it's over 122%. And it's been in that range for well over a year, for a long time. I can't remember when the debt to GDP ratio on the debt clock was below 100. So why are mainstream news outlets just now reporting that the debt to GDP ratio crossed the 100% threshold? Well, because they're measuring the debt to GDP in slightly different ways. The national debt clock factors in all of the debt that has been issued by the federal government, so gross debt. This includes debt held by the public, plus intragovernmental holdings. So essentially, this is money that the government owes to itself. For instance, if the Social Security Administration runs a surplus, it can invest in treasuries, and they do that. A lot of these government agencies will hold idle cash in treasuries. So of the $39.1 trillion in debt we have right now, around $7.8 trillion is made up of these intergovernmental holdings. And while one could argue that government debt held by the government is nothing but internal governmental accounting, those treasuries held by other federal agencies still have to be paid off with dollars at some point. So they are real debts. In other words, the Treasury is going to have to come up with that money. How's it going to do that? Well, it's either going to borrow more, so basically borrow money to pay for money it's already borrowed, or it has to get it through taxation. So it is a real debt. It's not just accounting. And no, the national debt clock isn't inflating numbers just to make things look worse than they are. The Federal Reserve maintains this same data. I'll put in the show notes page the chart that the Fed puts out that shows the entirety of the debt to the GDP ratio, and you'll see that it is over 122%. So both of these numbers, both of the ways of looking at this are relevant. The debt held by the public, which is the lower number that's used to generate the recent headline, it's more relevant in determining the economic burden of the debt and the pressure on the bond markets. The gross debt used to determine the national debt clock, GDP, debt to GDP ratio, is more relevant when trying to determine the fiscal sustainability of this borrow-spend regime. And the bottom line is both of these numbers are bad, right? And keep in mind, none of this takes into consideration the unfunded obligations that are looming in the future. I'm talking about Social Security and Medicare. That pushes the debt to over $100 trillion. So there's a lot of ways you can slice and dice the numbers, but no matter how you do it, they spell bad news. And this is why the Fed is in a catch-22. Right? I've talked about this for well over a year now. The Fed simultaneously needs to hike interest rates to fight inflation, and it needs to cut interest rates to rescue the economy, and it can't do both. I've been talking about this again for well over a year now. I think it's one of the most significant issues out there in the economy that just kind of gets glossed over. But interestingly, even CNBC is starting to figure it out. They published an article yesterday with this opening sentence: central banks risk a global recession by raising interest rates in a bid to contain soaring energy costs, an analyst has said. So there you go. He just summed up the catch-22, right? Well, this analyst has been saying this for well over a year, so I guess you guys are a little bit ahead of the mainstream. But, I would actually argue that holding rates at the current level is eventually going to have the same effect as a rate hike. It might just happen a little bit slower. And again, this is why so many people are jonesing for rate cuts. But eventually, all of this debt, all of the malinvestments, all of this is going to come to a head. And when the economy visibly cracks, what's going to happen? Well, I don't have a crystal ball. I can't tell you for sure, but I do know how Fed people think. And I've watched the central bank for many, many years. And what they're going to do is, if history is any indication, they're going to get even more aggressive in loosening monetary policy, whether there's elevated inflation or not, right? If history is any indication at all, it will cut rates to zero again and launch more rounds of quantitative easing. So that means more inflation, right? And as I've already mentioned, the Fed is currently running QE today, which indicates to me that the economy is not doing nearly as well as everybody wants you to believe. You don't run quantitative easing operations when everything is great. And I think the worst case scenario we're talking about is a protracted period of stagflation. And that's another word that you're starting to see pop up in the mainstream from time to time. I think a lot of people are aware of this, but they don't want to say it out loud, right? They know that the Fed is in a catch-22. They know there's too much debt. They know interest rates are too high. They know that cutting interest rates is going to cause a lot more inflation. They see the catch-22. What are you going to do? Well, we don't want to panic people, so we'll just kind of stick our heads in the sand and pretend like it's not happening. Well, that's dumb, right? You need to be prepared for what lies ahead. And you should take note of the fact that despite all of the worry about hot inflation that they're going to conveniently blame on the war, everybody is still yearning for rate cuts, right? That's why gold is up today. There's hopes that there's going to be more rate cuts this year. Think about that. Inflation remains well above the target, appears to be heating up. And there is still this grand hope for looser monetary policy, and it reveals priorities. And the Fed, I believe, will ultimately indulge this fantasy, right? If you watch the Fed closely, you know that central bankers tend to talk a lot about controlling inflation, but their actions always tend toward looser policy to boost the economy. In other words, when push comes to shove, the Fed people will accept more inflation and trade that for quote unquote, stimulating and protecting the economy. Because quite frankly, a bad economy feels worse to you than inflation, right? we're kind of used to inflation. Politically, inflation is more palatable. Now, if it gets too high, people freak out, and as we saw after the COVID fiasco. But generally speaking, inflation is more of this kind of silent, kill you by 1,000 paper cuts, right? So that's what they do. They tend toward inflation. In fact, I would argue that inflating is really the only fork that they have, right? That's all they can do. They can inflate the economy and then hope that things continue on. It's not likely to change. So, in other words, expect inflation to continue. And as I said, not being prepared is dumb, right? You need to have that inflation hedge now. There's a lot of people out there that are selling their inflation hedge because they think that the Fed is going to hold interest rates higher for longer, or that they're going to raise rates. Doesn't make much sense to me to get rid of my inflation hedge when I'm worried about inflation. But a lot of people are doing that. I think that's because a lot of people follow the leader in the markets. Don't do that. Get your inflation hedge. We're seeing these dips. We see dips in gold and silver. Those are buying opportunities. If you want real money that will hold its value over time, no matter what the Fed does, right? No matter how much money they create, no matter how much quantitative easing they do, you can have real money, gold and silver, and protect your wealth. Call 800-800-1865. Talk to a precious metals specialist today. I've already bragged on them, so I won't do it again. But make that call. And, I know a lot of people don't really want to talk on the phone. You may not have questions, or they may be simple questions. You can chat online with the precious metals specialist. You can go to moneymetals.com, or you don't even have to do that. If you know what you want, you want to get some Canadian maple leafs, or you want to get some gold American Eagles, you can go right to moneymetals.com. You can click on the various products. You can order online. We'll ship them right out to you. Or, again, you can store your precious metals in our state-of-the-art facility with complete confidence. But you want to do it today. We know the reality, right? Inflation is the policy. It will continue to be the policy no matter what they tell you. So that is a wrap for this episode of the Money Metals Midweek Memo. You can get more information about all of the stuff I've talked about on the show today and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up and get on our email list. Now, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you'll also be able to tune into our Market Wrap podcast that runs every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. I appreciate you listening to this show. Once again, thank you so much. I hope you have a fantastic rest of your week, and we'll be back here again next Wednesday.